Welcome to the deep dive. This is where we take those massive analytical reports, all that due diligence, the deep research, and we boil it all down. We're here to give you the core, actionable knowledge you actually need.
Right. We skip the noise, we skip the fluff, and we go straight to the insight.
And our mission today, I think, is one of the most compelling we've tackled in a while. We're going deep, really getting under the hood of an absolute energy heavyweight, Canadian Natural Resources. You probably know them by their ticker, CNQ.
Exactly. And the central question we've been tasked with, and this is really for you, the listener, is, well, it's a big one.
It is. How is a massive leading energy company being so systematically mispriced by the market?
And when we ran the full analytical framework on CNQ, the core discovery was, frankly, astonishing.
It really was. The analysts behind this report are calling it a generational wealth compounding opportunity.
And that word generational isn't just hyperbole. It's used because the market as a whole seems to be completely missing the fundamental transformation this company has gone through.
That's the key, isn't it? The transformation, the market's perception, it's all driven by headlines and oil price swings.
Right, the short-term noise. So it treats CNQ like any other volatile, unpredictable commodity stock.
But the deep data, the actual financials, the history of how management allocates capital, it reveals a totally different company.
A company that has fundamentally de-risked itself. It's become a stable, industrial compounder, not just a cyclical bet on oil.
And this disconnect, which the source material really hammers home, creates a huge quantifiable advantage. Our analysis found a 44% margin of safety at current prices.
Let's just pause on that. A 44% margin of safety, that's a massive undervaluation.
It is. So our job today is to unpack that. We need to figure out exactly where the market is looking, what biases are at play, and what key facts it's just completely failing to see.
And the report is so specific about this. It argues that nearly half of that 44% discount is, quote, purely emotional. It's driven by cognitive biases we can actually identify.
That's fascinating. A 44% margin of safety is a huge claim, so I'm really going to challenge you on this today. We have to prove that number.
Okay, let's do it.
We'll drill down into that valuation gap, we'll look at the macro trends that give them durability, and we'll stress test the financials against the 2020 crisis. We even have fresh Q3 2025 data to see if the thesis is holding up right now.
Sounds like a plan.
All right, let's start with that valuation challenge. A 44% mispricing. That suggests the market is deeply, deeply mistaken. Section 1. The mispricing paradox.
Right. So to really get this, we first have to understand the lens we're using. The analysis was run through a very comprehensive framework. The sources call it the diligent hand gauntlet.
So this isn't just looking at a PE ratio and calling it a day.
Not at all. It's a multi-factor system. It's assessing operational stability, capital discipline, balance sheet health, market exposure, the whole picture, and across cycles.
And what did this complex framework conclude? What was the final score?
The score was exceptional, 77 out of 100. And that's crucial because it immediately classifies CNQ as a high-conviction compounder.
And that's the highest tier in the framework, right?
It's the highest tier. It's reserved for companies showing that kind of systematic performance that promises, real, enduring, multi-year returns, a verdict that is completely at odds with how the market sees it.
Okay, let's bring in some skepticism here, because we have to. If the company is objectively scoring that high, 77 out of 100, why isn't Wall Street seeing it? Why are all these big institutional funds with armies of analysts missing a 44% discount?
That is the right question.
Are they really just being lazy, like the report says?
The short answer is kind of, yes. And the report digs into why. It says the market uses lazy, backward-looking metrics. What that means is analysts are fixated on two things.
Let me guess. Short-term oil prices.
One. And number two is immediate and often exaggerated ESG headlines. They just don't do the deep work required to see the systematic value creation that's happening under the surface year after year.
So what are the specific mistakes? The cognitive errors that are causing this huge gap?
The analysis points to 3 specific cognitive errors. And together, they create a 25% gap between the market's perception and the analytical reality.
Wait, so just to be clear, you're saying almost half of that total 44% discount is just irrational noise?
Purely emotional.
Exactly.
Okay, let's get to the math. Give us the hard numbers that expose this, the valuation disconnect.
Absolutely. So if you look at the conventional metrics, the stuff the market usually quotes, CNQ looks, deceptively fairly valued?
Like what? The PE ratio.
Let's start there. The basic price-to-earnings ratio sits around 12.7 times earnings.
That
It looks okay, but it's nothing special. It certainly doesn't scream 44% undervalued.
Right. And what about price to book?
Same story.
Yeah.
If you look at a superficial asset-adjusted price-to-book ratio just using standard accounting, it comes in at a relatively high 2.51 times.
So the average analyst looks at a 12.7 PE, a 2.5 PB, and just moves on. It's fine, I'll wait for a dip. That's exactly it. They think they're paying 2.5 times for the assets and that the earnings are just typical for a cyclical company. But the true analytical metrics, the ones from the framework, they tell a completely different story.
Okay, we need the detail here. What did the framework do to adjust those numbers so dramatically?
This is where the edge is. Let's start with the PE. That 12.7x is based on historical, often volatile, short-term earnings. The true PE of 8.5 times is calculated by normalizing earnings across a full commodity cycle.
So like a 7 to 10-year period.
Exactly. This normalized number reflects the true underlying earning power of the company, not just the result of one good or bad quarter. And at 8.5x, suddenly you see a company trading at a massive discount that was hiding in plain sight.
That makes sense. You filter out the noise to find the real signal. But that price-to-book adjustment is even more dramatic, from 2.51 all the way down to 0.80.
It's a huge shift.
How can you justify that? How can you say the market is paying 2.5 times for assets when you claim the true price is less than 1?
Because the conventional PB is just so misleading in this sector. Our framework adjusts for asset quality, which does two things. First, it reevaluates the replacement cost of their massive long-life infrastructure. I mean, you literally couldn't build these assets again today.
The regulatory hurdles alone would be impossible.
Impossible. And second, and this is the big one, it accounts for the conservative way CNQ books its resource base.
What do you mean by conservative booking?
It means their vast proven reserves, with a 40-plus year life, are valued on the books far, far lower than their true long-term economic value. The lazy sum-of-the-parts analysis just copies that accounting value. But our deep dive specifically found a 48% reserve discount.
A 48% discount, so nearly half the intrinsic value of the oil in the ground is just being ignored by standard market models.
Completely ignored. And when you factor that in, when you account for the true industrial value of those irreplaceable reserves, the asset-adjusted price to book just collapses, down to a mere 0.80 times.
And that's the aha moment.
That is the aha moment. You're not paying $2.50 for a dollar of assets. You're buying a dollar's worth of incredibly valuable strategic assets for 80 cents.
So the whole analytical edge has almost nothing to do with predicting the price of oil next quarter.
It's completely divorced from it. It's about recognizing the quality of the company's structure itself is systematically undervalued. The framework doesn't just see a stable company, it sees an anti-fragile compounder.
You've used that term antifragile a few times now. Let's be very explicit about what that means here.
Right. It comes from Nassim Taleb. It's not just about being tough or resilient. It's about actually getting stronger from stress and volatility. For CNQ, it means they use the commodity cycles as a tool.
How?
When prices crash and their weaker competitors are in chaos, selling assets, trying to survive, CNQ uses its pristine balance sheet to buy back huge amounts of stock on the cheap or make brilliant acquisitions. They actually profit from the disorder.
That's a powerful idea. An investment thesis based not on the commodity, but on the quality of the operator. So if they're designed to thrive in chaos, let's look at the chaotic world we're in. Section 2, macro alignment. How are they positioned for the big, durable trends?
This is where the story gets even better. When we isolated the analysis just for macro exposure, they scored an incredible 90 out of 100 on what the sources call the Agora score.
90 out of 100.
Yeah, that puts them in a very rare category, a prime compounder for macro alignment. It means they're structurally set up to benefit from the biggest, messiest trends that are going to define the next few decades.
Okay, let's break them down. The report identifies 3 powerful secular tailwinds that make CNQ strategically crucial. Let's start with the first one.
The first one is the most complex, but it's foundational. It's the energy transition coupled with the harsh reality of declining EROEI.
Okay, stop there. We need to define EROEI for everyone because it's a critical concept.
EROEI is energy return on energy invested. It's a simple ratio. How much energy do you get out versus how much you put in to get it? Think of it like a farmer. If you put in 1 unit of energy, seed, water, work, and get 10 units of food back, your EROEI is 10 to 1.
And for most of history, we've been finding energy sources with really high EROEI.
Exactly. Giant, easy-to-pump oil fields in Saudi Arabia might have had an EROI of 100 to 1, but we're now in an era of diminishing returns. The easy stuff is gone. New finds are deeper, offshore, harder to get. And renewables, while critical, often have lower energy density and need massive upfront energy to build.
So the EROEI of our entire global energy system is trending down. Why does that help CNQ?
Because in a world of declining EROI, reliable, high-density energy from a stable country becomes strategically priceless. CNQ's oil sands assets aren't like fracked wells that decline quickly. They are massive industrial facilities with 40-plus year reserve lives.
They're a foundation.
A foundation for North American energy security. As the global system gets messier and less efficient, their guaranteed stable output becomes more and more valuable. A premium that is not in the stock price today.
Which connects directly to the second trend, geopolitical realignment. The report calls it the Great Unraveling.
Absolutely. We're seeing a breakdown of globalized supply chains. The trend is moving rapidly toward friendshoring. Countries want to source critical supplies, especially energy, from politically secure, ethical partners.
And Canada is squarely in that friend category for the Western Bloc.
Perfectly positioned. CNQ operates entirely within Canada, so it's shielded from the expropriation risk or political turmoil you see in other parts of the world. The market prices a barrel of oil the same, but the risk profile of a barrel from Canada versus, say, a less stable region is totally different. That's another part of the mispricing.
And the third tailwind brings it back to our wallets, inflation and the end of cheap money.
Right. In a world of persistent inflation and currency debasement, you want to own real assets. Things with intrinsic value that can't just be printed away.
Which is exactly what CNQ has.
They have physical oil in the ground, massive industrial infrastructure, and a low-cost operating business with real pricing power. These are a natural, powerful hedge against inflation. They make sure your returns are real returns.
Okay, those three tailwinds are powerful, but we have to be diligent. What about the biggest headwind? The elephant in the room for any energy stock, climate policy risk.
It is a primary risk, but their mitigation strategy is a core reason they scored so highly, and it's very sophisticated.
So what are they doing?
First, they're not fighting the transition. They're positioning themselves to lead it within their sector. They're investing billions, with a B, into carbon capture and emissions reduction through the Pathways Alliance.
That sounds defensive, but how does it become an advantage?
Well, it repositions their ESG profile over time. But the real structural advantage is tied to what the report calls the energy realism thesis.
Unpack that for us.
Energy realism just argues that the transition away from fossil fuels is a century-long project, not a decade-long one. The scale is just too immense. And high-density energy, especially the synthetic crude oil CNQ produces, is absolutely essential for things like jet fuels, shipping, and petrochemicals.
The hard-to-abate sectors.
It's hard-to-abate sectors, exactly. There are no viable, scalable substitutes for those on the horizon. So by investing billions now to decarbonize their product, they're ensuring they will be the last and most responsible producer standing for the decades the world will still need it.
And those huge investments also create a barrier to entry.
A massive one. These multi-billion-dollar environmental projects act as a self-created regulatory barrier. Any competitor trying to start a new oil sands project today would face impossible costs and hurdles. C&Q spending actually widens their own moat. It's incredibly shrewd.
Okay, that's a comprehensive look at the external forces. So we have the mispricing, we have the macro tailwinds, now we need the hard proof. Let's look at the financial architecture and how it held up when the world was melting down. Section 3, the financial fortress.
Right, and the strength of this thesis really rests on the balance sheet. In the framework, the financial resilience score hit a peak of 93.2 out of 100 in 2024. And this wasn't an accident. It's the result of a deliberate 7-year de-risking plan that started way back.
And the ultimate test of that plan came in 2020. A global pandemic, demand collapsed, and oil prices briefly went negative. What did that extreme stress test reveal?
It revealed that anti-fragile character in high definition, the entire energy sector was in survival mode. Bankruptcies, dividend cuts, mass layoffs.
Chaos.
Total chaos. And in the middle of it, C&Q was systematically strengthening its position.
That seems impossible. How do you get stronger when your main product is worthless? Let's get into the specifics.
Start with the most symbolic move. Dividend discipline. This is almost unheard of in a crash. They didn't just maintain their dividend through 2020, they increased it by 13%. in March of 2020.
March 2020, that was the absolute peak of fear and uncertainty. The world was shutting down. To raise the dividend then, that's an aggressive signal.
It was a deeply confident signal to the market. It basically told investors, our business model is so robust we can handle this storm and still reward you. It instantly set them apart from every peer who was slashing payouts just to stay afloat.
A huge signal. What about their people? Most companies would have cut staff to save cash.
And that brings us to human capital. CNQ had 0 economic layoffs due to COVID. It was a strategic choice. They kept their institutional knowledge intact, so when the market turned, they were ready to ramp up immediately. No rehiring, no retraining.
And what about capital spending? Did they just stop investing to pay the dividend?
That's the impressive part. This is capital flexibility. They moved fast and cut about $1.4 billion in non-essential spending. But, and this is the key, despite that massive cut, they maintained their full-year production guidance.
So cut spending by over $1 billion, keep your output flat, keep all your employees, and raise the dividend. That only works if the machine is just spitting out cash no matter what.
Exactly, which is the final metric, cash generation. Even with the price collapse, they generated $5.343 billion in adjusted funds flow in 2020. That's resilience.
And the reason for that resilience is their break-even price. Tell us about that, because it's arguably the single most important number for their stability.
It's their ultimate defense. The WTI break-in price, that's the price they need to cover all operating costs, all maintenance capital, and the dividend is in the low to mid $40 per barrel.
Let's put that in context. If oil is at $80, basically everything from $45 to $80 is just pure free cash flow.
Essentially, yes. It's a profound structural advantage. The dividend is safe, even if oil drops and stays at $45 a barrel. Most of their competitors need $60, $70, even higher just to tread water. CNQ is built to be profitable at prices that would bankrupt almost everyone else.
Now let's track the balance sheet through that. What happened to their debt?
The net debt to EBITDA ratio did spike up to 3.7 times in 2020, but that was mostly because the denominator, the EBITDA, collapsed. As soon as cash flows came back, they deleveraged aggressively.
And where are they now?
They brought that ratio all the way down to what we call fortress levels. It's sitting around 0.9 times as of the recent data.
Less than 1 year of earnings to pay off all their net debt? That's incredibly conservative.
Immensely conservative. And crucially, they kept their investment-grade credit ratings through the entire crisis. That access to cheap capital is a huge long-term advantage.
And what about their immediate cash buffer, their liquidity?
As of Q3 2025, they had a huge war chest. $4.314 billion in total liquidity. And that's not just a safety net. It's their opportunistic fuel. It's what allows them to go on the offensive with buybacks and acquisitions when everyone else is panicking. It's the engine of their anti-fragile strategy.
The financial structure is clearly rock solid, which leads us to the people in charge. Section 4, the leadership edge.
Yeah, the fortress is just the structure. It's management that makes it work.
Yeah.
And in our analysis, they scored a 97.5 out of 100 for leadership excellence. They're firmly in the elite green zone.
And that's a score earned through crises, not just good times.
Exactly. And nothing proves their conviction more than what happened with their own money in 2020. The insider conviction signal.
Right. The stock collapsed below $14 CAD. The market was in full panic mode.
Lull panic. But the insiders, the execs who knew the true break-even costs, they were quietly buying with their own personal capital. Aggressively. That's why the conviction score was 98.0.
Imagine being in that boardroom. You know your assets are cash positive at $45 oil, and you're watching the stock trade at a price that implies total disaster.
To buy, then, is a profound statement. It's saying, the market is irrational, we trust our model, and I'm betting my family's capital on it.
And that bet paid off spectacularly.
Massively. The stock delivered an 83.6% return in 2021. It was a masterclass in contrarian value investing by the people with the most information.
And that decision-making is why they scored a 95.5 on capital allocation mastery. So how do they achieve that?
Their whole philosophy is laser-focused on per-share value creation. They don't just grow net income, they grow earnings per share, EPS, faster. And they do that by being ruthless about share buybacks when the stock is cheap.
Like in 2020.
Exactly like in 2020. Low stock price isn't a threat to them. It's an opportunity to retire equity and give every remaining shareholder a bigger piece of the pie.
And the ultimate proof of this discipline is their dividend record.
It really is. They are a true dividend aristocrat, which is so rare in the energy sector. We're talking 25 straight years of dividend increases.
And not small ones either.
Not at all. A 21% compound annual growth rate over a quarter of a century. It's astounding. It shows a deep, structural ability to generate cash through any cycle. The current yield is a healthy 5.51%, and we've already established how safe that payout is.
So we've got the financials and the leadership. Now let's talk about the operational moats that protect it all.
The business quality scored 93.0 out of 100, and the analysis noted a widening moat trend. This is all driven by what they call the CNQ way, just a relentless focus on operational excellence and cost leadership.
And how does that cost leadership translate into a real quantifiable moat?
It comes down to their oil sands operations. In Q4 of 2024, for instance, their operating costs were just $20.97 per barrel. That consistently puts them in the top tier globally.
Why do those low costs matter so much?
Because they're the first line of defense. When oil is high, it's pure profit. When oil crashes, it's the difference between life and death. Their cost structure gives them the endurance to outlast every downturn and emerge stronger.
And what protects those assets?
Two things that feed each other. First, a massive cornered resource, a 40-plus year reserve life, all in stable Canada. And second, those regulatory barriers we talked about. It's now virtually impossible to get a new oil sands project permitted.
So even if a competitor wanted to come in and try to match CNQ's costs, they couldn't even get started.
They absolutely could not. So the very regulations that scare off generalist investors are actually making CNQ's position stronger every single year. The moat is widening by default.
And what about succession? Is this elite performance just tied to one person?
No, and the recent leadership transition proves it. When Tim McKay handed over to Scott Staff, it was a seamless transition to a 28-year company veteran, an operations guy who lives and breathes the CNQ way. It prioritizes continuity and culture over personality, which dramatically reduces key man risk.
That's reassuring. Okay, the internal quality is clear. Let's bring it to the present day. What catalysts are happening right now, and how did they perform last quarter? Section 5.
This is where the thesis gets a major accelerator. The single biggest game changer for all Canadian oil, and especially for CNQ, is the completion of the Trans Mountain Expansion Pipeline, TMX.
This has been in the works for decades. What does it actually do for CNQ's business?
It fundamentally changes their risk profile. For years, Canadian crude was bottlenecked, forced to sell at a discount almost entirely to the U.S. TMX has nearly tripled Canada's export capacity to 890,000 barrels per day.
Giving them global access for the first time?
Real reliable global access. We're already seeing their oil reaching China, India, California. This reduces their dependence on the U.S. and gives them huge negotiating leverage.
And the result should be that the discount on Canadian oil shrinks.
It already is. We're seeing the WCS-WTI differential compress. The price gap between Canadian heavy crude and the U.S. benchmark narrowed from over $13.50 a barrel a year ago to just $10.36 a barrel in Q3 2025.
And that extra $3 a barrel is pure profit, straight to the bottom line, a massive structural win.
A huge win. And it removes one of the oldest risks tied to Canadian energy.
So let's look at the Q3 2025 numbers. Did they execute?
They absolutely did. They hit a record for quarterly production, 1,620,261 barrels of oil equivalent per day. That's up a staggering 19% from the year before.
And the financials?
Very strong. Adjusted funds flow was $3.92 billion. Adjusted net earnings were $1.8 billion. And critically, they stuck to the plan. They returned $1.5 billion to shareholders in the quarter, $1.2 billion in dividends, $300 million in buybacks. They're doing exactly what they said they would.
Okay, but we have to address something that might confuse someone looking at the report. The official net earnings number was way lower, only $0.6 billion. Why was there such a big gap?
This is a critical point. It highlights the difference between real operations and accounting noise. That low number was because of a huge one-time $1.258 billion non-cash recoverability charge.
A non-cash charge.
Right.
And it was related to their international asset.
Entirely. Their non-core legacy assets in the North Sea. Basically, the estimated future costs to decommission an old field came in higher than expected, and they had to account for that now. It's an accounting charge. No cash actually left the bank.
So it has zero impact on their cash flow, their ability to pay the dividend or buy back stock.
Zero. It's just accounting prudence for old, non-core assets. The North American core business is absolutely booming.
And the operational excellence, the cost control, that continued.
World-class. Even with inflation, their oil sands operating costs were just $21.29 per barrel in Q3, still securely in that premium sub-$25 tier. And their thermal assets were even better, at just $10.35 per barrel.
Staggering efficiency. And they're also looking to the future with natural gas. Tell us about the LNG deal.
It's a very strategic move. They signed a 15-year supply deal with Cheniere, starting around 2030, to sell their natural gas priced off the Japan-Korea marker, or JKM index,
And why is that JKM index so important?
because it gives them global LNG pricing. Canadian gas prices can be really volatile and cheap. This deal links a big chunk of their future gas production to the much higher, more stable global price for LNG. It's a great diversification move.
And finally, there was the big post-quarter event, the Shell swap.
A brilliant move. They acquired the last 10% of the Athabasca oil sands mines, so now they are the 100% owner and operator. In exchange, they gave up a small 10% piece of some downstream assets, like an upgrader.
So they traded a sliver of non-core infrastructure to get total control of the core mining asset.
Exactly. It's a classic move by a management team focused on operational control and long-term asset quality.
The catalysts are strong, recent performance is strong, the thesis holds up. But now, the most important question for any investment, what could go wrong? Section 6, risk management.
Right. From conviction to surveillance, we've got 4 main risks, and for each one, the company has a clear mitigation strategy already in place.
Let's start with the big one, the market's biggest fear, technology disruption. The idea that EVs and renewables will make their oil worthless.
We see this as a low probability risk, at least for CNQ specifically. Their product, synthetic crude, is premium feedstock for jet fuel, heavy shipping, and petrochemicals.
The hard-to-abate sectors again.
Right. Things that can't be easily electrified. And their mitigation is that multi-billion-dollar Pathways Alliance investment. It's designed to make their product the most responsible choice for those sectors for decades to come.
Okay, what about regulatory risk? A hostile government could change the rules.
The manageable risk. Their big existing operations have grandfathered approvals, which protects them. And honestly, the Alberta government relies so heavily on royalty revenues from companies like CNQ that they're unlikely to kill their golden goose with overly punitive policy.
What about a simple recession? Oil prices crash.
A medium risk, but it's what the financial fortress is built for. That low to mid $40 break-even means they stay profitable and can go on the offensive with buybacks when everyone else is in crisis mode. They were built to weather that storm.
And the final risk, geopolitical. What if the U.S., their biggest customer, puts tariffs on Canadian energy?
That risk is now directly mitigated by the TMX pipeline. For the first time, they have real access to Asia and other global markets. They're no longer solely dependent on the U.S., which gives them huge optionality against any potential protectionist policies.
So for the listener who is convinced and wants to monitor this, what are the key metrics to track each quarter?
There are a few key things. First, financial health. Keep an eye on that net debt to EBITDA ratio. You want it below 1.0x. It's at 0.9x now. Also, watch free cash flow generation. You want to see that consistently strong.
Second, operational excellence.
Watch the operating cost per barrel. It has to stay below $25. Right now, it's around $21, which is excellent.
Third, capital allocation.
Are they actually buying back shares? Look for a 2-4% annual reduction in the share count, and make sure the dividend is well covered by cash flow, over 2.0 times. It's at 2.4x now.
And lastly, market position.
You've got to watch that WCS-WTI differential. Now that TMX is online, you want to see that spread stay narrow, under $15 a barrel. The current level around $12.50 is very healthy.
So to sum it all up,
the summary is, this is a core long position, suitable for 5-10% of a quality portfolio. There's a 44% margin of safety, and the base case expected annual return is a very compelling 12 to 15%.
this has been an incredibly detailed deep dive. So to synthesize it all, we've shown how Canadian Natural Resources has really transformed itself from just another cyclical energy company into a genuinely anti-fragile industrial compounder.
Yeah, they use the chaos of 2020 to lock in world-class low costs, build a fortress balance sheet, and keep the talent they needed to execute.
And the market, still stuck in its old thinking, keeps treating it like a volatile commodity play. It's ignoring the structural design, and that's creating the systemic undervaluation that patient investors can take advantage of.
And new catalysts like TMX and smart strategic moves like the Shell swap are just accelerating their ability to compound value for years to come.
The evidence really is conclusive. This is a management team that systematically gets stronger during downturns. That is the definition of anti-fragility.
They see market fear as their best friend.
Which leaves us with the final provocative thought for you to really consider. If this management team consistently uses market disorder crises, fear, panic to create permanent competitive advantages, then the question you have to ask is this.
Is the market's irrational cognitive bias, its insistence on mislabeling CNQ as merely cyclical, Not a risk to the company at all.
but a permanent compounding gift that is regularly handed to patient analytical long-term investors.
It's the ultimate gap between market psychology and business reality. And that's where patience and rigorous analysis can find their greatest rewards.
We hope this deep dive gives you the knowledge and the conviction you need to approach this opportunity with clarity. We'll see you next time.